Hey, real talk for a second. Are you absolutely sure your car insurance actually covers you? Or are you just throwing money away every month? And what about your credit score? That speeding ticket from last year? Meet 5 ordinary Americans who discovered the hard way what happens when you get car insurance wrong, and more importantly, how they fixed it. So this is Alex from Dallas. He just bought his first car, and the dealer told him Texas minimum coverage is fine. That's 30, 60, 25 coverage. But here's what Alex doesn't realize yet. In Texas, that minimum liability means if he causes a serious multi-car accident, his insurance would only pay up to $30,000 for one person's injuries, with a maximum of $60,000 total for all injuries in the accident, and just $25,000 for property damage. In today's medical costs, one serious injury could easily exhaust that entire $30,000 limit in just the emergency room. And that's before surgery, rehabilitation, or lost wages. If the damages exceed his coverage limits, Alex could be personally sued for the difference. His one speeding ticket and average credit score. They're pushing his premium even higher, making proper coverage feel unaffordable. Then there's Maria in Chicago. She's got the house, the kids, college funds, retirement savings, everything they've worked for. But here's her dilemma. She's paying for 100, 300, 100 liability coverage. But is that really enough? If her teenage son causes an accident while driving her car, and the other driver suffers permanent injuries requiring lifelong care, that $100,000 per person limit could be exhausted quickly. The other driver could go after their family assets, their home, their savings, their future earnings. Maria's agent says increase your liability, but with 2 kids in college, every extra dollar counts. She's stuck between protecting their assets today and affording their life today. Meet Chloe in Miami. She worked years for this BMW. Everyone's telling her she needs comprehensive coverage for hurricane season and collision coverage for accidents. But here's what nobody explained clearly. Comprehensive covers her car against theft, vandalism, fire, floods, falling objects, like those hurricane-flying patio furniture pieces. Collision covers her car regardless of who's at fault in an accident. But with her premium doubling, she's wondering if she's overinsured. The reality is, with a new luxury car in hurricane-prone Florida, both coverages are essential. But she might save by increasing her deductible from $500 to $1,000. Here's David in Los Angeles, driving Uber 20 hours a week to get through grad school. What most gig workers don't realize is that personal insurance policies often have ride-share exclusions. Here's how it works. Period 1. When the app is off, personal insurance applies. Period 2. When the app is on but no passenger yet, there's often a coverage gap. Period 3. When you have a passenger, Uber's insurance applies but with high deductibles. David needs a specific rideshare endorsement, which typically costs just $15 to $20 monthly, but could save him from financial ruin. His college damage credit score? That's adding another 30–40% to his premium, making every coverage decision more stressful. And this is Mr. Thompson in Phoenix, on a fixed retirement income, watching every dollar. He's been paying for full coverage on his 2015 Camry for years, but here's what he needs to consider. His car is now worth about $12,000. If his comprehensive and collision coverage costs $800 annually, he's paying nearly 7% of his car's value each year just for these coverages. A good rule of thumb? When your annual premium for physical damage coverages exceeds 10% of your car's value, it's time to consider dropping them. But he needs to have enough savings to replace his car if it's totaled. Here's what none of them realize yet. That average credit score? According to industry data, it could be increasing their premiums by 40 to 50%. That's an extra $500 to $1,500 every year. In most states, insurance companies use credit-based insurance scores because statistics show correlation between credit behavior and claim likelihood. That one speeding ticket, potentially adding 20–30% to their costs for 3 to 5 years. And choosing the wrong insurance company? J.D. Power's 2024 Claim Satisfaction Study shows that customers with poor claims experiences are 80% more likely to switch companies. They're all making the exact same critical mistakes. Getting just one quote instead of shopping multiple companies. Not understanding how state-specific laws affect their requirements. Underestimating how credit impacts premiums in most states. And being completely unprepared for the claims process until they're in crisis mode. But here's the good news. There is a systematic way to fix this. First, liability coverage. For most people, 100, 300, 100 is the smart starting point. But if you have significant assets, consider 250, 500, 250, or even an umbrella policy. The cost difference is often surprisingly small, sometimes just $20 to $30 monthly for much higher protection. Now, the company selection strategy. According to J.D. Power's 2024 studies, Erie Insurance ranks highest for shopping satisfaction, while NJM Insurance leads in claim satisfaction. But here's the key insight. The best company varies by state, driving record, and vehicle type. That's why getting multiple quotes is non-negotiable. About that credit score impact. Improving your credit by 50-100 points can save 15 to 30% on premiums. Dispute errors on your credit report, pay down credit card balances below 30% of limits, and avoid new credit applications before shopping for insurance. The claims process demystified. When filing a claim, document everything with time-stamped photos before moving vehicles. Get a police report for any significant accident. Notify your insurance within 24 hours. Keep a dedicated folder for all claim-related documents. Follow up consistently but politely. Companies with high claim satisfaction scores typically process claims faster with better communication. For budget optimization, beyond the usual bundling and safe driver discounts, ask about lesser-known discounts like pay in full, paperless billing, early shopping, and professional organization memberships. Increase deductibles if you have emergency savings. Most importantly, shop around every 6 months, especially when negative items age off your record or your credit improves. So here's your actionable game plan. First, inventory your assets to determine adequate liability limits. Second, get quotes from at least 5 companies, including regional insurers. Third, work on credit improvement as a long-term strategy. Fourth, understand your state's specific requirements and common claim scenarios. Fifth, align your coverage with your actual risk exposure and financial capacity. Want to implement this step by step? Here's what you can do right now. Grab a notepad and write down these 5 assessment questions. What's my total net worth? What's my car's current value? What's my credit score? What discounts might I qualify for? What's my emergency fund size? Use these answers to guide your coverage decisions. And if you want more specific guidance for your state situation, check out your state's insurance department website. They often have free coverage calculators and consumer guides. If this deep dive helped clarify the complex world of car insurance, hit that subscribe button because we're breaking down more financial protection topics every week, from homeowners insurance to retirement planning. And if you have specific insurance questions, drop them in the comments below. Remember, the right insurance isn't about finding the cheapest price. It's about securing proper protection at a fair price. Don't let confusion or procrastination put everything you've worked for at risk. Get the coverage that lets you sleep peacefully tonight, knowing you're properly protected.